Today we are going over 7 support and resistance trading strategies and how to use them on your charts. So hello, welcome back, and let's talk about the 7 different support and resistance trading strategies and how to use them in your trading. So the first one is called a 3-drive push, and this is something that is often luring in new traders and inexperienced traders. It is also something that many traders with FOMO are struggling with. FOMO, by the way, stands for the fear of missing out. And the 3-drive follows very similar or always the same process. So you have your first resistance level that gets established after a trending move. You can see the market use this as its turning point, starts a downtrend, and then the market comes back and it trades back into this level. And many traders are anticipating a sell-off when the price gets to this level again. However, as you will probably know, many amateur traders and many struggling traders have issues, and they always fear that the market is going to leave without them, that the price will turn before they can get in. And then what happens is that such traders are often entering the market too soon. And whenever the market is coming close to a previous resistance level, obviously many traders will start watching such a market. And then very often the traders who struggle with FOMO, they will get in here and they will get in here, or if they wait for the market to move away, they will get in here or here. And because they fear that the market is going to leave without them, the market is already very close to the previous resistance, and maybe such traders think, okay, maybe the market is going to leave without me and I better get in. But what then happens often is that those traders, they get squeezed on the 3rd drive. So you can see that this is a very classic phenomena. You have your first drive, you have your second drive, and then you have your 3rd drive. Very common behavior. And the 3rd drive is often the one that is taking out the previous high. So you can see the 3rd drive, the 3rd push, is actually reaching the previous high. And it's not only reaching the previous high, it's taking out the previous high. Why is that so? Let's assume you get in on this move or on this move. Where is your stop loss going to be? Very obvious. The stop loss is going to be here above the highs. That's where all the trading books, all the trading literature will tell you that is where you put your stop loss. And now you have 2 problems. First, you are in the trade too early. You got in here, or maybe you got in here. Second problem is that your stop loss is at a level that is very obvious in the market. And then it's very simple for the big money, the smart money, and just the traders who can be more patient to drive the market through your stop loss, generate liquidity, and then you can see how strong did the price then take off. You can see that strong spike took out the stops, and then the next candle the market completely sold off, and you can see that small retracement and then another downward leg. So this is very common, and whenever you see that the market is close to a previous resistance area, stay patient. Learn to sit out, learn to not do anything, and wait for the market to really get to the level. This is very common behavior, and don't try to be the first in the market. Exercise patience and your trading results will often see a big improvement. The next one, I use at 50 SMA. You can also use an EMA, and you can use the break and retest function of the moving average together with support and resistance. So whenever you see that the market is giving you a bottom pattern after a trend. So you can see the market was here in a downtrend. Then here you have your bottoming pattern where the market goes from lower lows to higher lows. You have an established resistance level here by connecting the previous highs. Then you have your breakout, and then the next candle or the next 2 candles, the next 3 candles, you get your retest squeeze. So when I zoom in, this is a very common behavior. The market does not immediately take off, but it stays around the price level, the resistance level, and takes out all the traders who have a very tight stop loss and who are already in the market. And then you can see then the next push happens. Obviously, sometimes you won't be able to defend this. If you're a breakout trader, you will get in here and your stop loss will often be taken out if you use a tight stop loss approach. But you can then use this retest function or this retest behavior to get into the trade once again. So use that as a second entry. And then you can see afterwards you will often have a very nice trending market. Here is another recent example. You can see the market was in a downtrend, then it turned around here, you have a divergence inside here, and then suddenly the moving average gets broken on this candle. And before the market takes off, this is such a common behavior, something that we will take a look at later once again. This is then going for the retest of the moving average together with the previous resistance. So you can see support becomes resistance, and then here becomes support again. Together with the 50 moving average it held, and then the market shot up higher and started this huge bullish uptrend. This is the daily chart, so you could also, once the market has broken out, go to a lower time frame and wait for a retracement pattern on the lower time frame, and then trade this retest with a multi-time frame approach. Here we have two different support and resistance approaches. The first one is stop fishing, targeting break-even stops. So here is a regular head and shoulders pattern. We can see that here we have the left shoulder, the head, and the right shoulder. We have a very well-defined neckline here by connecting the swing points, and then the market broke out. Very strong breakout, started a downtrend. Many traders will probably get in here somewhere on the breakout, and then when the market moves in their direction, in their favor, what are they going to do? If the market doesn't reach the take profit, they will then move their stop loss. Where are they going to move it? To the break-even area, which is here the entry. And then later the market comes back into the entry and takes out the stop loss and starts a new bearish trending phase. So this is really, really common. And if we delete now this, and let's delete the neckline. So this is where you got in on the breakout. This is where then your stops are being fished for. And we can see the second concept, which I called deceleration and acceleration. We can already see it here in play. When I zoom in, you can see, and I made videos about this before, you have a strong candle here at the origin of the trend, and then as the market gets closer to a previous support and resistance area, the candles get smaller. So you can see here a small doji candle, then here a pin bar, and then the market accelerates away from the level. And again, the market moves into the level, the candles get smaller at the resistance, and when the market is moving away from the resistance area and the resistance held, the candles are increasing in size. And we can see this here in action very, very nicely. So you have a strong uptrend leading into the resistance. Where's the resistance coming from? It is the top of the head. So very significant resistance, which already led to a sell-off before. So you can see, especially here in the last leg, very, very obvious deceleration and acceleration. So you can see here we have the market, the trend is accelerating again. So we have a very small candle here, a larger candle here, another huge large candle here, another strong candle here, and then the candles get smaller and smaller and smaller, and now the market turns around. It did reach the resistance. So again, remember the first principle. Even if the market is coming close to your resistance area, wait and learn to sit on your hands. Wait to do nothing until the resistance and the support has actually been reached. Look for deceleration, acceleration. Maybe you even get a complete spike that goes above this area to take out the stops. And then you can see on the way down, the candles then accelerate again and get larger. And yeah, just show you this nice turning point. It's like a ball in motion, or if you throw a ball, you will see that in the beginning it's very fast, and then as it approaches the tipping point, it gets slower and slower and slower, and then at the top it gets faster and faster and then accelerates to the downside. This is a very, very common behavior in price action when you look at momentum structure. Let's take a look at two more examples with deceleration and acceleration, and then move on to the next support and resistance strategies. So we have a significant high and low here, and we have an area of resistance here. So once you are able to define maybe the first and the second resistance, then you start being aware of the level, and then you can see, even if we just have a few candles, you will be able to see this phenomena often at play. Strong candle, weaker candle. This candle also takes out the previous highs, so you have 2 in 1. You have deceleration and acceleration. Strong candle becomes smaller, also takes out all the stops from everyone who has their stops here above that, and then on the way down the candle accelerates and gets larger. So you can really see this shift in power dynamics at resistance and support level. Here we don't see it as nicely, but you can still see the market jumps into the previous resistance area, and then there is no follow through, there is no next candle, no next bullish candle, and then on the way down you can see then the market accelerates. First we have an indecision bar, so at the turning points you will often see either a doji, which is a long candlestick with a small body, or you see a complete rejection in form of a pin bar. But in most cases you have candles with a small body at least at those resistance and support levels. If those levels don't break, it's a very, very good add-on or a good confluence factor to have on your charts. And then the market comes back to the next level. Here we can see this pattern. It's often called, I think, a shooting star or an evening star or whatever. You have a strong candle leading up to the resistance level. This will make it look like, wow, the market is ready to break out. Let's get ready for the breakout trade. The market is finally able to push above the highs, and then everybody jumps on it. But the next candle here is the Doji Candle, very small body, long candlestick wicks. What does it show? It shows indecision. It doesn't show a lot of buying support. It doesn't show that the buyers are really ready for the breakout. And then the next candle is then the complete reversal. Very, very strong bearish candle, shows that there's no breakout momentum at all, no interest in the breakout, and then you'll see the market is breaking lower. Here, when we extend the level, you can see a very different example. So the good breakouts, they are often the ones that are not the most obvious ones. So you can see the candles leaving into the resistance level are not really strong. Here, the pre-breakout candle is actually quite small compared to what happened here. So whereas here, a lot of people who are impatient and who are lacking or who are suffering from FOMO probably already jumped on this trade. They got in squeezed. Whereas here, the traders, it didn't look as obvious. It didn't look like the market is really ready to perform a breakout. But then the breakout did happen. So whatever is really obvious in trading at first glance is usually not the right thing to do. So you really need to be patient, and you really need to be waiting for confirmation before getting into a trade. That's the key. Here, this is how good breakouts look, and it's one of my most favorite price action patterns. I've talked about this in the past. Breakout buildup. Once you have a support or resistance level defined, you wait how the market is trading into the level, and if you can see the breakout buildup, which is before the breakout, you will often have this last final push away from the level, which does not look very strong. Compare this to this high, and you can see the market is making a significantly lower high, which already tells you that there is not a lot of buying support in the market, and that the buyers are not even able to get the price close to the previous high. This is often a nice way that the market foreshadows a breakout. And you can see the breakout happened, the market moved a little bit lower, not too much, but then we have the opposite signal on the other side. We have this triangle pattern where we have this very nice established resistance level at the top. At the bottom, we can already see that the lows are already progressing higher. So we already have some type of hint that the buyers are getting stronger with those lower highs. It's a very, very classic and important market tell. So how does the market move? It's already pushing higher and higher and higher, but this resistance is still keeping the price from making the actual breakout. And then before the breakout, you often have this little breakout buildup. So the market is not able to really pull away from the level, but it's also not really breaking out yet. So the market is really sticking to the level. The buyers are more in control, and the sellers, although they are trying, they cannot find the same momentum here or here where the market really sold off and had a huge rejection at the level. So this can tell you a lot about who is in control, how are the bulls and the bears and the power dynamics shifted or balanced at those resistance levels, and then you can see this strong breakout afterwards. We have a trap pattern, which is something that we have talked about already here briefly, and it's such a nice way of visualizing or understanding the buyer and the seller dynamics. So here is where everything starts. You have your support level which gets established. Then the market does its thing. The market comes back here into this level. So here is where the market finally reaches the support level again. Everybody wants to trade off of this resistance level, support level. And then you have even here your somewhat little bit ugly but still valid head and shoulder pattern. And everybody's jumping on the breakout. The breakout then fails. And the market not only comes back into the previous lows, but keep in mind, everybody that is long here on the breakout, where are they going to have their stops? Some people will have a tight stop. Other people will put the stop loss right underneath the previous low, because that is what technical analysis usually suggests. Put it at the lows. Is it safe? But if you see that the market is going for the stop, this is, first of all, you just can't do anything about this, not always, because what you're going to do, you're just going to set your stop loss infinitely far away from the level. Doesn't make too much sense because you're ruining your reward to risk ratio. Sometimes you just have to take the loss here, and you just have to understand that, okay, this is not something that I can't handle with, because sometimes the market will just break lower and not come back. But if you see that you're broke, that you are stopped out, and if you see that the market is immediately returning back into the range and make it look like a trap pattern, then use this as another way of looking for trades into the trend direction, and use this as a bull and a bear setup or bear trap setup, because that's what it is. It's a very, very common behavior, because it's really targeting the stops of the traders that have already entered here. And then if you are a victim of a trap, then don't give up prematurely. If you can see a pattern, then try to get back in. And we can see the dynamics here at play again. When I zoom out, or when I shift this a little bit, let me move this around. We can see it again. Let's take this off again. We have, how does the market move into the level? Small candle. Whoops. And then we have the big candle here afterwards. Again, the market makes it look like it's ready to break out. Huge, strong candle. So the people who are long are probably scared out. The people who want to get short, they probably jump in here already because they don't want to miss this move. And then the next candle is your reversing momentum. It is the doji with the rejection. And then the candle afterwards is a super, super strong bullish candle. So you can see the deceleration and acceleration at play again. We have a trap pattern, and we can really see how the market is always trying to trap and get the people, or try to get the people on the wrong foot, make it look like it's ready to break out, super strong momentum, and then it does the exact opposite. And here, to conclude it, we have the break and retest pattern again at support and resistance. Very, very common behavior. So we have established here a resistance level, the first swing point, the second swing point here. We have a breakout buildup. Let's get rid of this. So in here, we have a breakout buildup. The market is really not able to pull away from the level. You can see that it's really sticking to the level. Then on the next attempt, we have our successful breakout here. Again, the market is not really pulling away. It is retesting the level. And especially here, this is where you then get your retest signal. That is a pullback signal, which many, many traders trade. It looks like the market is ready to pull away here. It comes back. It takes out everybody who moved their stop loss to break even too soon, with this huge candle, and then you have your engulfing candle. This is an outside bar, which I explained in my last video on my YouTube channel. You can check that out as well. And then it is the origin of the trend. So really important lessons here in this video. A little summary. What you need to be aware of is that if something seems too obvious and something seems just too good to be true, usually it isn't, and the market is just trying to fool you. Be aware of that. Second, wait always for the price to really get to the level. Don't do anything before the market gets there. Don't act on FOMO. Be patient, learn to sit on your hands and really wait for the market to get to a level. Look for rejections, look for spikes through a level, look for traps, and also understand and always think about where are the majority of traders putting their stop loss at, and then try to understand how they are approaching their trades, because this will help you a lot in your trading as well. So I hope you liked this video. If you did, leave a thumbs up, leave a comment, and you will hear from me on my next video.